All right, official good afternoon, everyone. It is 12:01 p.m. on the East Coast. I want to welcome everyone. My name is Brock Jolly, and on behalf of the NAFA executive team, as well as the staff, certainly appreciate everyone being here today. Like a lot of you, dealing with all the joys of trying to run a business out of my home. I've got a 6-year-old son who we're doing, financial planning for him in the basement, kindergarten on the main floor. So 6-year-old son could run in here at any time. The dog might run in. I've got somebody mowing my lawn right now, all kinds of good fun. So I know everyone's going through the same thing. And on behalf of NAFA, we want to be here to serve as a resource for everyone, answer a lot of your questions. We had last week on our town hall meeting, we had over 2,300 folks who attended that meeting live, had lots and lots of great questions. And so we decided that we wanted to do a special session today, really to get a lot of those questions answered. And the interesting thing on all of this is we're getting guidance from the federal government, as well as from banks, from other professionals, just talking a little bit about what's going on out in the market today, and more guidance on this. And so we'll connect more on that, but we want to give you where things stand today and give you some ideas. And certainly these are things that you can use to, certainly, if not maybe more importantly, how you can really be a leader on behalf of your clients and those you represent to help them navigate the waters of this new normal. Because for all of us, we're all trying to figure it out. No one was an expert on this until about 10 days ago. And, we've assembled a real all-star panel here today of folks. And so I'll talk about that here in a second. But just some of the background, I want to catch everybody up to speed a little bit on this. As most of you are familiar, there are 3 relief bills. There's some guidance that there may even be a 4th. NAFA is really paying close attention to what the Treasury Department, as well as the Department of Labor, is putting out. There have been 2 loan provisions. The first is what's known as EIDL, or the Economic Injury Disaster Loan, and the other is the Paycheck Protection Program. So the key is just understanding what those programs are, how they work, how you qualify, what the process is really, really important. And on behalf of NAFA, we want to just make sure that our members, and as importantly, the entire financial services industry, can view NAFA as a resource in these trying times. And so today we've brought back all of our speakers from last week's webinar. I'm going to get into that in just a second. But also, if you weren't here at the webinar last week at the town hall meeting, I'd encourage you to go to the website at the bottom of this slide here. You can go to belong.nafa.org, and you should be able to find an on-demand recording of that webinar. So I'd encourage you to go there. We've also got lots of, we've got all the past town hall meetings with folks like Tom Hegna and others who have been with us. We've got lots of others coming up. And some great content from folks like Joe Jordan, Wade Pfau, David Resseguie, Deirdre Van Nest, Jamie Hopkins was on our webinar on Monday. So lots and lots of good resources for you. Everything from sales ideas to practice management, things to be really, really valuable for your practice. We also are going to have our next town hall on April 16th, or I shouldn't say that, a week from tomorrow. Our town hall on April 16th will be a deeper dive on the Paycheck Protection Plan. And so that will be the NAFA government relations team. So Judy Karsrud, who's on our call today, Diane Boyle, and others, really just taking that deep dive onto the Paycheck Protection Plan and understanding how that program works. Also, we've brought in our outside counsel from Steptoe and Johnson, and they're fantastic and are really experts on that. These are the ones who go and read these 800-page bills to really dissect them and understand what is there and what they need to know. So just some housekeeping things as we dive in a little bit deeper here. At the bottom of the Zoom panel, you should have a chat box. You can go there. You can put information in the chat box. I and others from the NAIFA team are monitoring that. We'll try to get some of those questions answered through the process of this webinar. But in addition, we'll try, if we've got time at the end, we'll also revisit that section and come back to get those questions answered by our panel. So with that, I want to turn it over to our experts today. And first, I want to introduce Judy Karsrud. Judy is the AVP of Federal Government Relations at NAIFA, and just a vast wealth of information. She's a great resource and just so on top of this stuff. I mean, I'll tell you, I've traded dozens of emails with Judy this week in preparation for this webinar and just on other topics. And she's just really at the pulse of what's going on in Washington, and just a really, really positive attitude, and, you know, somebody who I want on my team to navigate these waters on behalf of me in my practice, as well as trying to be a great leader and representative for our clients. Second is Keith Gillies. I think Keith Gillies needs no introduction among a NAIFA audience. Keith is I guess he is the immediate past president. So was the president 2 years ago, and just did a great job in a real transitional time for NAIFA as we implemented the QME program, and was just a visionary leader for NAIFA. And so excited to continue to have Keith involved and be a leader as we navigate these new waters and try to understand kind of the new normal in the coronavirus era. And so Keith runs a very, very successful financial planning firm, part of Emeritus Financial, based down in the New Orleans area. And so I'm going to let Keith introduce his two co-panelists, and then we'll come back on the end, like I said, and have some time for Q&A. Judy may chime in on some of it. But with that, I'm going to turn it over to Keith. And please do use that chat box to ask any questions that you may have, and we'll go from there. So with that, Mr. Gillies, I will turn it over to you to take the floor. Thanks very much.
Thank you, Brock, Judy, and the rest of the NAIFA team. I will tell you that you have been invaluable to the advisor community as we have tried to navigate this whole virus and the legislation that's come since then. So Zach, you're going to be moving the slides.
Yes, sir.
Okay, so let's get those moving. First, I want sort of a disclaimer. Todd, Mark, and I, who I will introduce in just a moment, have done a series of these things for other organizations over the past week or so. And we want to make sure that everybody understands that we're keeping this at a high level. The legislation is less than 2 weeks old. The Paycheck Protection Program is less than a week old. So it's the market, the environment is always and everlasting changing. So there's guidance that comes out every day. There's questions that come out every day. We are here to help you navigate that. But I want you to know that the answers provided here are to the best of our current knowledge and cannot be construed or relied upon as tax, legal, or financial advice. So with that, let's get started. I want to introduce two really good friends of mine, Todd Villarubia and Mark Massey. Todd and I go back over 20 years, a couple of decades. He is one of the top tax attorneys in the country. We've worked together for years on high-level, high-net-worth client planning, and he comes to us from the Wealth Planning Law Group. Likewise, Mark Massey. I've known Mark for probably 25 years. And when I say this, Mark is one of the most knowledgeable, if not the most knowledgeable person I know when it comes to qualified plans. And I'm happy to have both of these gentlemen on our team as we navigate our clients and advisors through this very difficult period. On top of that, the three of us all live in the greater New Orleans area. Todd and I both live in the city, Mark just right outside of it. and the city's been on lockdown, and you've probably seen that on the news. So we're doing the best we can to communicate with technologies. So with that, let's move on to the first. Let's get started on these questions. Okay, first of all, let's talk about loans. These are SBA loans. The first one is the economic injury disaster loan, and then the second one is the payroll protection program, paychecks protection program. Todd, why don't you talk about a little bit about the first one, the EIDL?
Sure. Thanks, Keith, and thanks for that nice introduction. Hello, everybody. Welcome from New Orleans. I hope everybody's staying safe and strange times, but frankly, I want to encourage everybody to really view this as an amazing opportunity. I think it's your business owner clients that are going to help pull this economy through these troubled times. So I'm honored to be a part of this panel, and thank you again for inviting me, NAFA. Just to give y'all just a brief background, on the EIDL program, you simply just need to go to the SBA website and apply for that. My understanding is that they're going to forward you a $10,000 check if you had a business that was in existence on February 15th, and that money will be then factored in if you then go apply to the payroll protection program as a separate loan. But the EIDL part of it will be factored in when you go to do the payroll protection program. If you do not do the payroll protection program and simply do the economic injury disaster loan, it is our understanding that the intent is to forgive that loan, and it will be a grant to the business owner community. And the payroll protection program, unlike the EIDL, which is, again, the EIDL is done straight through the SBA website, the payroll protection program, on the other hand, is being administered by SBA approved banks throughout the country. And we would encourage you to work with your local banks to find out who's participating. Not everybody's on board yet, but most of the major banks, from my understanding, have now started to implement the payroll protection program. There is a cap of $350 billion on this. There's been talk this morning that they're going to, I think, add another $250 million to the program.
Billion.
Billion to the program. So, there's a lot that's evolving with this, but for the PPP program purposes, you're going to want to apply for that through your local lender that is SBA approved. And there's a host of documents that you need. You need 940s and 941s for your payroll for 2019. If you have a tax return that's been filed for 2019, you're going to want to submit that. There's a bunch of documents you're going to need.
Yeah. So there's a question here about how do I determine which one is better for my small business? And these two particular loans are not mutually exclusive. When we talk about there is a tax credit, payroll tax credit program that some businesses who do not qualify for the PPP can use in lieu of the PPP. But with both of those, you can still, you can still do the EIDL loan. So Todd, you want to talk just a little bit about that?
Yeah, they're not mutually exclusive, guys. So I would encourage everybody that's on the call, not only, even if you're a financial advisor, a statutory employee typically, you also will be eligible for some relief here under different parts of this program. But for your business owners, again, guys, this is an amazing opportunity. It gives you a reason to get in front of your business owners that are your clients, and to be a tremendous resource out there. There's a lot of misinformation out there right now, and you can really be a thought leader for your business owners and really strengthen that relationship. I've never in my 30 years of practice seen such an attack, if you will, on the entrepreneurial community that is so widespread across many industries and obviously globally. And this is an opportunity for you to get in front of them and to really be a resource for them going forward, to understand the differences. But you should be encouraging your clients to both apply for the EIDL, which we had heard originally that $10,000 would get here as quickly as 2 weeks, whereas the payroll protection program has to go through all the underwriting and stuff. It's going to take a little bit longer. So that, as Keith correctly points out, they're not mutually exclusive, and you might as well go apply for both of them. You can always turn down the PPP program if you decide to, but as we're going to get into later, portions of that loan under the PPP program will be forgiven if they're used for qualified purposes for salary, to really, keep your employees working over the next couple of months.
Let's go to the next. Yep. Well, we just answered that question. So if my understanding, and I guess somebody's having some construction going on or something, but it's my understanding that if you qualify for the EIDL loan, so if you're approved to get a loan, that they will advance $10,000, and that will be in the form of a grant. So let's move to the next slide. As far as I know, there is no deadline for the grant, but there is a limited amount of money. The original phase 1 was $7 billion. And Judy, do you know if that was expanded? I didn't see anything about expanding it. Okay, let's just go to the next slide. Okay, so on all of these things, anybody who's gone through this process for the PPP, there were lots of confusion last week around the application process. When you finally get to the real PPP application, there is a question that asks if you have applied for any of these other loans. I would advise, maybe not, I would recommend to all of our colleagues on this call and for their clients to pay very careful attention to these questions. And I think disclosing more information is better than less when they're asking you for something. But there's one that they do not cancel out one another. However, the EIDL and the PPP loans must be used for the purposes they're designated, and that you had some coronavirus effect to your business. You can't use these to pay off other loans or mortgages. Ladies and gentlemen, stay within the lines on this thing. Todd, do you have any brief comments on that?
I'm sorry, I had a little bit of background, Keith. That's why I was on mute. No, I think you summed it up very well. Thank you.
Okay. All right, let's go next slide. There's a lot of questions, so we're gonna try to roll through these pretty quickly. So
you want me to?
Yeah, Todd, you've handled this before, so I would talk.
Yeah. Let me address this. So the question is, can a business owner take a business deduction for eligible payroll expenses that are paid for with PPP or EIDL funds? Okay, a couple of things on this, guys. First of all, we've had a bunch of different types of questions on this. Does it cover full-time employees, part-time employees? The answer is yes. We believe that it does not include money for 1099 independent contractors if they were on your payroll. But to be clear, if you pay someone over the next several months to do work for your company, that if it's an ordinary and necessary business expense, it is deductible, period. Then the next issue becomes, okay, when we're going with the PPP and EIDL funds, if you use those funds for the payroll, then what's going to happen is that you're not only going to get the ordinary necessary business deduction for paying the payroll, but part of the PPP loan will be forgiven for basically 2 months of your average payroll from last calendar year for 2019. So if you take your average payroll for 2019 and you figure out what that monthly average is, they're actually going to give you 2.5 times that amount, with 2 times that amount being for the payroll, the other 25% effect being for interest and some other items that are typically expenditures for a business. But that portion of it should be forgiven for the next 2 months, if I'm being clear about that, Keith.
Yeah, and it's also that part of the provisions, and again, this is all brand new, and we're going to have to wait for some guidelines, and some of this stuff is going to be retroactive, so we need to be very careful. As I've read through this, the loan forgiveness is not taxable.
That's my understanding as well.
Okay. Can a nonprofit company that is currently in review for 501c3 status qualify for either of the loan programs? Okay. There was just some guidance that I saw yesterday, and this is, again, it's evolving very rapidly. Originally, you had to be a 501c3. I am pretty sure that yesterday or late Monday night, there was some guidance that said other nonprofits could apply for the PPP program. There are still some firms that are excluded, and that includes under, I think it's Rule 7A of the SBA program, finance companies. Todd, do you want to tackle whether or not you can nonprofits can qualify for the EIDL?
Yeah, just a couple of things. The quick answer is yes. How this works, guys, when you set up a nonprofit 501c3, typically you file either the trust or the corporation with the state's office if it's a corporation, and then you apply for the IRS. And what they will do for the tax exempt status, once they grant that, which last time I checked, it was taking them up to a year oftentimes to approve it, it actually dated back retroactively. So what I suspect is going to happen here is if you formed your charity before February 15th, the fact that the IRS hasn't given you charitable status yet to approve it does not mean, in my opinion, that you won't be eligible. I think you'll still be able to apply because your entity existed. The fact that they haven't granted you the tax exempt status yet, I don't think is going to have an impact relative to EIDL. It will have an impact on PPP, assuming you didn't have any payroll last year. I think you could have some issues with that. But for EIDL purposes, I think you certainly should at least try to apply it and move forward with that.
Thanks, Todd. Next one. A business owner has borrowed money, second mortgage equity line, on personal assets and put that money into the business. The answer to that is these, as we said earlier, I think we've already answered this. These funds must be used to keep your business running during this crisis. They cannot be used to repay any other loans. Do you agree?
Absolutely. Again, I think you got to bifurcate it. There's one issue is, okay, I've got this personal debt that I've taken out. The second issue is, can you get a PPP and EIDL? The answer is going to be, in all likelihood, yes. But then the next question becomes, if you use those funds, for example, on paying off personal debt, then you're not going to get it forgiven. If you instead, the purpose of PPP is to really put money into your employees' pockets so that you as a business owner can continue to pay your people. It's really not benefiting the business owner directly, in my opinion. It's really meant, to help with your employees. So if you wind up using it for personal reasons, you're not going to get the loan forgiven. Whereas if you put it towards payroll, then the loan should be forgiven once you can prove that it was used for those purposes.
So also, let me just, again, please stay within the lines. My greatest concern is that 2 years from now, the Inspector General of the SBA starts doing audits on these loans. You took one of these loans, you used it to pay off your car or your whatever you bought inside of your business, and then you get into a trap with them. Stay within the lines. Again, I think we've answered this question a bunch of times. Go ahead, next slide.
Keith, if I may,
Yeah.
maybe the example that you and I went through yesterday might help the audience some.
Okay.
So let me kind of walk through that, if I may.
Okay.
So let's say last year, guys, you had a business owner whose average payroll when you looked at 2019 was $10,000 a month. Okay. under this PPP program, you're going to be able to apply for, again, it's 2 times, so 2 months worth, with an additional 25%. So it winds up being about 2.5 times that monthly amount. So let's assume for a second that you have a business owner whose payroll averaged $10,000 a month last year. You will be eligible for 10,000 times 2.5, which is 25,000. Or if you had 100,000 average payroll, then it would be 250,000. It's 2.5 times. Now, let's say from the time you get the loan, instead of spending 10,000 a month, you only spend $5,000 a month because your operations are slower. What would happen is that the money that you spent in 2020 over the next couple of months on salaries would be forgivable under the PPP terms, but the portion of it, in my example, the balance of the 5,000 that's not currently being used, you might be eligible for a loan for it. It's simply that you're not going to be able to get it written off down the road.
Thanks, Todd. Okay, let's move on to the next question. If you have a client with 2 separate businesses, are both qualified, or is it only 1 loan per person? So it's my understanding that if you have distinct businesses, particularly like this was specifically mentioned for people who have in the hospitality or restaurant business, where they might have, for example, over 500 employees, they can treat in each business as a separate entity. And I believe if you have, if you're involved in different entities, you would have to, number one, if you're more than a 20% owner, you're going to have to disclose that on the PPP for each of those businesses with those tax ID numbers. And I would also caution you, if you have income from those entities, to not take over the $100,000. I don't think you can spread out. I think it would be unwise to spread out 5 companies that you're involved in with $100,000 each and try to get that from each of those companies. Todd, a quick summary, a quick comment?
Yeah, to be very clear here, let's assume that you had 2 businesses and you're making $120,000 off of each business. I would submit that I think that you apply for the PPP for each business, but your aggregate personal salary as the owner, I don't believe you should be trying to take the $100,000 equivalent amount. So let's walk through that real quick. That they're going to cap your compensation for either the owner or any key employees to an annualized amount of $100,000. So if you made $120,000 for business 1 and $120,000 in business 2, I think that you can only apply, or you should only apply for one of those. I don't think they're going to allow you to take separate personal compensation for each company is my concern. I think you could take it for all your employees, and clearly you've got to cap it at an effect what is $86.66 a month, which equates to $100,000 a year. So I think there's 2 different limitations. One is the $86.66 monthly amount times 2.5 for your personal comp, and secondly, I would be very nervous about applying for that personally as the business owner on multiple companies. I think you can apply for their employees, no question, but I'd be a little reluctant to do it. I think the intent was to cap the owner there at that $100,000 effective amount.
Thanks, Todd. Next slide. Yes, we already answered that. Yes. My understanding is that interest will not accrue. Is that yours as well, Todd?
Yeah, I think for 6 months, I believe.
It's and
it's a low interest rate, like 1 or 2%.
1%.
Yeah.
Todd, the number is $83.33 a month. Just a minor math.
I'm so sorry. Yeah, I should know better as a tax attorney. Sorry.
Man, look, if you haven't filed your taxes, I wouldn't start trying to file for these special loans. But that's, I mean, I would have that client ask their CPA about that, but they may not have one since they're not filing their taxes. Go ahead, Todd.
I agree. I wouldn't take a chance. I mean, you got to get your taxes straight first.
Yeah. All right. right. This is another provision that allows you this payroll tax deferral, that you can defer your payroll taxes now, and then you will be able to pay those back by, I believe it is 12/31/2021. So you'll have some time to pay that back later. And it's my understanding that if you have less than 500 employees, you can do this. We can get the very specifics on that out to you, and I believe it's already on the NAFA website. The tax rebate. I'm not exactly sure what this is. This might be what was part of phase 2. So in phase 2, there was a provision that allowed tax credits for you, particularly if you were in a very affected, and if you were in an affected area with an affected business, where you could take tax credits. You could get tax credits up to $5,000, I believe the number, 50% of payroll up to $5,000 per employee. And you could take those credits out of your payroll taxes due. Again, we can get you some drill down on that, but we've got a lot of other questions to get to, but that is something that is really pretty readily available, pretty straightforward. Also on that one, those businesses that are excluded from PPP can often take advantage of that tax credit program. And please look at the FAQs that NAFA has provided. A lot of this stuff on the drill down is there. Again, we're trying to keep this at a high level for you. So there's specific, this next one on commission sales people. Many of us or 1099 employees or contract employees, Schedule C employees. If you're filing a Schedule C, it's my understanding that you're eligible to apply for the PPP beginning this Friday. So if you have Schedule C income, then you can do that. Todd, quick response to that.
Yeah, each one of you that are financial advisors on this call should absolutely apply for it.
And there was a question that said, I read physicians were excluded. It's actually the opposite. They're specifically included. Okay, next slide. I don't know the answer to this. It's my understanding if you're above the threshold, you're phased out.
Yeah, I would think that you're above the threshold. The other point I want to make here that Keith and I have addressed is with the downturn in the markets overall, I think you should be thinking about talking to your clients about potential Roth conversions. But if you do that, you got to watch that it doesn't push your client into above the limits that they have in order to qualify for the tax rebates. Keith, could you maybe go through the example you used yesterday, where somebody maybe in 2018 made too much, but in 2019 maybe got part of the phase out? Could you walk through that example for everybody?
Yeah, so this is an advance on a 2020 tax credit. So if you had not filed your 2018 taxes, if you filed your 2018 taxes and you were above the threshold, but in 2019 you were below the threshold or the phase out period, this happened to a relative of mine, then they're worried about, well, I'm going to lose this or lose some of this credit. And the answer is not, because you will be able to recover anything that you did not get when you filed the year. And to Todd's point about the Roth conversions, which may be a very good idea at this point, if within those threshold limits, be very careful about that, because you may push yourself out of it. Okay, next slide. If you earn above $100,000, the cap is $100,000, and it's $100,000 of payroll. And I read some guidance yesterday that the $100,000 cap does not include employee benefits, and it does not include like 401k contributions, employee benefits being health insurance benefits that are paid. So yes.
mind, I just want to really hammer home that point, guys. There's a couple of things. Again, don't minimize the value to the entrepreneur clients that you have in deferring the payroll taxes until the end of 2021. Cash flow is king right now. You know, trying to maintain cash for these guys is going to be critical. So make sure they're aware of that, number one. Number two, there are going to be all sorts of planning opportunities coming out of this, I think, including Roth conversions and similar things. The third piece is that when you're doing the calculations of average payroll for last year, as Keith correctly said, it's not just your W-2 employees. It's the health insurance premiums that go into that, get added on to that compensation, the W-2 income. It is the match retirement accounts that you put in for the match. It may also, we've heard conflicting things about whether or not the FICA and FUTA withholding, whether or not that's supposed to get factored in. My advice to everybody on the call is for yourselves and for your business owner clients, give it all to them. Give it all to your SBA, because as this thing continues to get more and more clear, then you want to put into this calculation as much as possible.
Let's go to, we've talked a lot about this. We've got about 20 minutes left, and we really need to get to some of this stuff involving qualified plans. So Zach, can you get us to the qualified plan slides? And then we'll come back to these if we can. All right, Mr. Massey, I know you've been sitting patiently there. Why don't you give us a highlight of what you're seeing, what's going on, and more importantly, something that's not in this particular legislation, but relief for employers and plan sponsors today. Mark, turn it over to you.
My camera working?
We really don't want to see you, but
I was going to take my shirt off if it wasn't. It's kind of warm in here.
Mark, you can click the thing that says start video. There you go, brother. Please don't
turn on there. So what a difference a week makes. When we did this a week ago, we were just days into this coming into fruition, and it was raining information from every record keeper in the country that was frankly not consistent in any form or fashion. So over the last week, everything started, eggheads like me, and analyzing all this data, trying to put it together. And particularly in the last 24 hours, everybody seems to be singing off the same sheet of music now. So what I've done is take a dozen or so questions that I've received over the last week, and didn't have time because I was working on this as late as this morning, because everything's so much clearer now than it was, to get it to the slides. So I'm just going to read these and address them. And I think after you hear these Q&A session, you should be able to answer 90 to 95% of questions that you get in this area, because I've kind of picked and choose the good ones with some help. Question: Can former employees take Coronis-related distributions, or is it limited to active employees? In other words, as I keep using an example, last year I worked at the Nashville Sequence Mining Company. I left, came to my new position, so I'm a terminated employee, but I hadn't rolled my K yet. The answer is yes. It applies to terminated participants as well as active participants in their 401k for taking a Coronis-related distribution. Next question: Can participants take multiple distributions as long as the amount remains under 100,000? The answer is yes. So I tap it for 25 and that turns out not to be enough. I can go back and take additional money as long as I don't exceed the $100,000. Okay. Next question: If a participant's spouse is laid off, would that qualify the participant to take a COVID-19 distribution? This one surprised me. The answer is no. I guess they're making the assumption there that as long as there's one income in the household, you're going to be okay. Really not consistent with the rest of the message, but it is what it is. This next question has come up a plethora of times this week from multiple people. And to be frank, some of the some of the times I've got this question right after last week's. I gave a couple of people the incorrect answer, and I've emailed them since and corrected it. And again, this is confusing. You know, they could take 3 words and put it in a bill, and those 3 words were in-service withdrawals, and that throws people like me into the ozone because, you know, in-service means in service, but in reality, it doesn't in this case. So what they really are trying to do is get people money, okay? So the question, can someone take the distribution out of their IRA instead of the 401k? The answer is yes. So on the distribution laws, you can take them out of your IRA just as you can as a K. If you're working there or not, it doesn't matter. So the only thing that's different is the loan provisions, because obviously, but as most of you know, you can't borrow from an IRA anyway, okay? So anyway, IRA, 401k, multiple buckets, take your pick. Next question. I've been dating Mary Lou for 10 years. She wants to get married, but I'm afraid that, I'm sorry, that question's from my Dr. Massey's Love Line podcast. Next question. I have an outstanding loan on my 401k. How long can I suspend payments? A lot of confusion on this. When it first came out, they thought that you could suspend those for 12 months, but you can't. You can suspend them till 12/31 of this year. So let me play out an example. Let's say I've got an outstanding loan right now for, I don't know, $10,000. I can go in today and say, all right, I want to suspend my loan payments for the rest of this year when you're repaying the loan. However, you can only do it till 12/31 of this year. So that's going to start back your repayment schedule in January. Next question. I have an outstanding loan balance of $28,000 now in my 401k. Can I increase my current loan? What this person is asking is, can I re-amortize this to take advantage of the Coronis distribution loan policy, we'll call it? And the answer is yes. So I could go up to an additional $72,000 because, as I said, the loan was 28, 72 plus 28 being 100, and then re-amortize my loan schedule and begin payments next year. Okay. Next question. Can a plan sponsor set a lower limit than 100,000 for distributions, i.e. 75,000? So your client really doesn't want to open Pandora, open the gates to being able to take $100,000, their employees to take $100,000 out of their 401k. The answer is yes, they could set a lower limit. I don't see a lot of people doing this, but that was a question that submitted, so I did want to address it. So you can do it. Next question, gotten this one probably more than any. Can I roll money out of my former employer's 401k into an IRA, then take the distribution from the IRA? And the answer is yes, but why? And the reason why I say why is, and again, I call the controller at the Sequence Mining Company, and now I got to go through the dance of deciding whether if the paperwork that my 401k is going to get the money to the IRA, or does the IRA require their paperwork? And while we're doing the paperwork shuffle to decide which one works, and then you got to transfer it over, 8 weeks have passed and I'm broke. Or, during the period that the IRA is being transferred to the 401k is being transferred to the IRA, I could be out of the market for a few days. And, we all are watching the market and we know how up and down it is. I wouldn't suggest getting out, because you could just take it out as a terminated participant. So why go through the exercise? But the answer is yes. Next question, is the plan sponsor required to disseminate CARE Act information to their participants? I found this interesting. In other words, we got these options, we have to let our employees know about it. The answer is no, it's not required. But if you add the provisions without notifying the participants, and let's say the owner then takes a withdrawal, you could have a benefits, rights, and features non-discrimination issue. Be kind of like starting a safe harbor plan, not notifying your employees, although they do require that. If they do exercise adding these distribution and loan requirements, you should notify your employees, just good practice. Then the last in this series is, how about Roth withdrawals? Did the Act address them? The Act did not discuss Roth. And, as you probably know, in a Roth, you have to leave the money for 5 years before it to be a non-taxable event to begin with, and you have to be 59 and a half years old. So no Roth changes. Back to you, Keith. Hello?
Hey, guys.
You're on mute.
I'm sorry. Let's get back to some of the slides we may have missed. We've got about 8 minutes left. College age students, well, I have absolutely no idea. I didn't get that granular into if college students would not get something. And I guess the question is, are they getting the $1,200? There's all kind of rules around college kids who are under 22. If they have not earned their bachelor's degree yet, there's all kind of rules around financial aid and so on. I'm going to call upon it. Brock is still here. He is a true expert on this. He may have an answer. He knows more about college kids than anybody I know. Brock, can you chime in if you're available?
The college category, sure, but I don't know on this topic. I guess the question being college age students, look, if they've got a loss of income, I think would be eligible for it. But I don't know, Todd or Mark, maybe if you're able to answer that. I don't know that answer.
This is on the tax rebate check. So this is on the tax credit program. And I believe that these rules have the same thing to do with financial aid for college students, that it has to be based upon your family's income, unless you've been, what's the legal term, Todd?
Emancipated.
Emancipated from your
So,
parents.
Keith, can you guys hear me?
Yes.
Yes.
If I can jump in here, I can't explain it, but the $1,200 tax rebate to individuals who qualify if their income is low enough includes a $500 per minor rebate as well, but does not include, I think it's both high school seniors and some college students. I can't explain the reasoning for that, but that is in fact that a few of your kids, even if they are your dependents, would not be eligible for the $500, assuming your family income allows you to be eligible for that.
Judy, you've been working with in the halls of Congress for many, many years. If you can't understand their thinking, I don't know if anybody else can. So let's go on to the next slide, please. We've answered this a lot in the chat. If you're a Schedule C employee, you file a Schedule C, yes, you can do that. And I believe it's Friday for Schedule C sole proprietors to file. Okay, next. Bonuses are included in wages and salaries. We had this question come up a couple of other times. Todd and I talked about it. Just make sure it's reasonable. Todd, you want to touch on that we got about 5 minutes left, so I want to get to the rest of the slides if possible.
Yeah, just real quick. Again, I think you got to look at it two different ways. Bonuses that were paid in 2019 absolutely should go into your average monthly comp. There's even talk this morning that it wouldn't only include W-2 income, but potentially dividends. We're not certain of that yet, but there is some talk about that being a loophole for last year, as opposed to this year, when you then go pay the salary and look for forgiveness, again, you're going to have that $100,000 annualized amount, the 8333, that you're going to be limited. And I think you got to be careful that you're not doing stuff again that would be somehow viewed as fraudulent there. So if if you're usually paying yourself $5,000, but you go pay yourself another $3,000 just because of the forgiveness, you might have some issues.
Okay, next slide. What is amount allowed for appreciated stock against adjusted gross income? Todd's the estate planning guy. I think this has to do with the charitable deduction, Todd.
Perhaps so. Yeah, I mean, it's a little convoluted. The appreciated stock, until you sell it or gift it, it doesn't really have an impact. You just have built-in capital gains. But relative to the charitable limits, the typical rule is that when you're giving to at least to a public charity, you're limited historically to 50% of your adjusted gross income. But under the new legislation, there is 100% deduction now allowed. So literally for your high net worth, high income type clients, this is a really amazing opportunity to both reduce their estate tax, eliminate any income tax for 2020. And then of course, for the agents on the call, a potential sale of an insurance policy as an income or as a wealth replacement vehicle.
All right, next slide. Unemployment insurance benefits. Okay, so we have gotten this question a lot in our business. And what's happened is in the world out there, if you have someone, like I have a client, friend of mine, who owns a business where they do these jumping things that you have at parties. And so they get in there and the kids jump around. I think we've all seen those. And he has blue collar workers who are doing that. And he had to lay those people off because we're not doing jumping things right now. At least you probably shouldn't be doing jumping things. And his question to me was, if I take this PPP and bring my people back, there's nothing for them to do. They would be earning less than now what they will get with this $600 additional 10-week program that was part of the CARES Act. So, I mean, I agreed with them. Here's a situation where a business owner, instead of taking this loan, okay, is saying, not only if I take the loan and I pay it out to my employees, that'd be great. I'm hurting them. And I'm potentially, what I explained to him is, you may be putting yourself at risk for taking this loan and having your employees do nothing. So that's, if you're laid off right now and you can qualify for unemployment, it's an extra $600. Also, self-employed people, even we went over this last time, Uber drivers can apply for this. Anybody, again, all of these people who file Schedule C as Schedule C employees are eligible to apply for the PPP. Okay, next. That's up to you. I mean, should you pay your employees if they're not coming to work? I don't think that's beyond our pay grade here as to what you want to do. Yes, next. I'm not an unemployment expert on this. I do know that there are provisions if you're a stay-at-home, if you have to stay at home because of your children, there are some opportunities for you with the act. Next one. Okay, I think Mark, did you cover RMDs? Let's talk about RMDs until Mark gets back on. So required minimum distributions are suspended right now. Mark, are you back online?
Can you hear me?
Yes, sir. You want to talk about RMDs?
Yeah, we covered them last time, but I will go through them again. It's pretty straightforward. 4 bullet points. Hold on. 4 bullet points. Qualified 401A, K, 403B, and governmental 457 plans. This also includes IRAs. Will not be required to make any RMD payments for 2020, specifically A, participants who turned age 70 and a half prior to 2019 and will not be required to receive an ongoing RMD for 2020. B, participants who turned age 70 and a half in 2019 and who did not receive their first RMD for 2019 on or before 1/1/20 and will not have to receive their first 2019 or 2020 RMD. C, beneficiaries receiving life expectancy payments will not be required to receive their 2020 beneficiary RMD. And lastly, beneficiaries who have an account balance in the plan subject to the 5-year distribution rule can exceed it to 6. So those are straight up rules.
Yeah, thank you. There was lots and lots of stuff here, lots of really good questions. We're going to wrap it up on our end. Thanks to NAFA for putting these events on. I think they're helpful to all of our colleagues across the country. And I want to thank Mark and Todd for, again, giving up their time to participate. So Brock, I'll turn it back to you, buddy.
Perfect. Thanks, Keith. And, again, just to reiterate, Todd, Mark, Judy, Keith, really, really appreciate your knowledge and expertise and for taking the time out today to be with each of us. Just a reminder, we've got that deeper dive onto the payroll protection program on the 16th. In addition, we've got NAFA town hall meetings every Monday and every Thursday at noon for the duration of this coronavirus quarantine. So really want you to join us. Good resources for you. We'll also be putting together a frequently asked questions document that will be on the NAFA website. There's already lots and lots of information there. I told you, Judy's working overtime. Her team is just doing a lot of work on behalf of our members. And so I'd encourage you to go visit the website security.nafa.org. So security.nafa.org has lots of resources. You can go on the far right-hand side of that page, and you'll see resource kits. There's information specific to the COVID-19 pandemic. On the screen right now, you've got a really great resource specifically for small businesses that dives into a little bit more depth on the Paycheck Protection Program and the EIDL grants. So I'd encourage you to check those out as well as great resources for members and non-members alike. That said, if you're a member, I'd strongly encourage you to encourage non-members to become members, because that's how we continue to get these resources provided to you and really serve as the advocacy arm for your business and help you to differentiate yourself as an advisor who is making a difference on Main Street in America. So with that, right at 12:59, appreciate everybody's time. Wish you best of luck out there and look forward to seeing you live and in person sooner rather than later. Thanks, everybody.